Beware of this classic tip-off behavior in the stock market. I'm Bob Stokes with Elliott Wave International. If a major stock index makes a new low in a bear market, but other key indexes have turned up, this divergence is usually a sign that the bear market is at or near an end. The same applies to a bull market. As an example, over a decade ago, shortly before the start of the Great Recession, our October 1st, 2007 U.S. short-term update told subscribers the Dow Jones Industrial Average made a new high today, while the majority of stocks did not. Historically, this is not a good combination and reinforces our view that the rally is in its very latter stages. About a week later, the U.S. stock market hit a historical top, which was followed by a bear market which lasted nearly a year and a half and brought with it the biggest economic contraction since the Great Depression. Fast forward to the February 22nd, 2021 U.S. short-term update, which showed this subscriber's chart and said the trends in the three main U.S. stock indexes have diverged over the past week, as shown on the chart. The Dow is at new highs, the S&P 500 declined to its lowest level since February 4th, and the NASDAQ Composite declined to its lowest since February 1st. Fractured trends may not be healthy in a bull market, as it often suggests a narrowing of the advance. Predictably, just 3 days later on February 25th, the Dow dropped nearly 560 points. Some observers attributed the big slide to the action in bond yields. Stocks momentum has faltered the past week as investors have faced a sharp and swift rise in bond yields. However, the behavior of the stock market itself had already been tipping its hand. Indeed, divergent behavior was also displayed on February 26th, when the Dow Jones Industrial Average fell 470 points, while the NASDAQ climbed 73 points. This is what we mean when we say that to forecast the market, you have to look at the market itself, not at the factors outside it, like the economy, unemployment, and other so-called fundamentals. Another way of focusing on the market itself is to study the Elliott Wave price patterns of each of the main stock indexes. As Frost and Prechter's Wall Street classic book, Elliott Wave Principle, Key to Market Behavior says, no matter what your convictions, it pays never to take your eyes off what is happening in the wave structure in real time. Ultimately, the market is the message, and a change in behavior can dictate a change in outlook. All one really needs to know at the time is whether to be long, short, or out. We study the Elliott Wave price patterns of over 50 global markets day in and day out. Follow the link below this video to get the timely insights you need about the main U.S. stock index's wave structures so you can make high confidence preparations for what's likely next.